All right, gang, it is that time of the week, the best Tuesday you've had all week long, and we are stoked to be joining you live in studio. With me is the Whiz Kid,
Matt Dixon.
All right, are you really? I mean, is kid the right term though?
You
I feel
know,
like the Whiz Young man. No, that doesn't make
when I
sense.
start getting a bunch of wrinkles, we'll get rid of it. But until then, we're gonna stick with it.
Okay, whatever you say.
Okay.
So I'm your host, David Littlejohn. We're stoked to be here on this a really just a crappy time in the stock market. So it's going to make for a very interesting show. Uh, by show of hands, that I cannot see for all of my listeners out there, just how many people think that we have an ugly stock market. And if your hand is not raised, then I'm like, please call the office because we need encouragement.
Indeed.
I mean, it is just an ugly world out there. We are officially
We're in bear market.
bear markets, right? And so not BARE, right? BEAR. Exactly. Bear market. You mean like summer where you can take your like short sleeves and stuff? No, no. I mean like 20% down from the peak levels of this market. Now, I do think it's ridiculous when people say things like, oh, well, we have a market crash. I don't even know how to define crash because that just
What
sounds
does that look like?
inflammatory, right? But we do have like a market mess. And so that's the part where I'm like, all right, well, big old market mess. And what does that mean? It means there could be more downside, is I think what it means.
Oh yeah.
And maybe so it's hard to poll people on the radio here. We're talking about, well, what might we do? You know, what do we think? What do you guys want to hear about? But I will tell you that there's a general underlying theme to this that we're going to spend a little time unpacking today. Okay? Like, why do you think the markets are down so much, Matt?
I mean, I think a lot of it has to do with inflation.
Yeah.
I mean, the Fed is over there scratching its head, raising rates, and we're expected for another big rate hike. They're
Right?
trying to get it under control, but I mean, I think the last report was 8.3, however they measure that.
8.6 for CPI, I believe.
Okay.
You know, there are lots of different ways that this gets measured, but yeah, so far we're at 8.6 is the most recent that I've seen, and that is from the Department of Labor, published on June. So I guess it was previously it had been 8.3, but now 8.6 is the average for the last 12 months, so it's up from 8.3.
The gas prices, that's not helping. The supply chains, that's not helping. We've had a few things that have been really dragging it, I feel like.
Yeah, and so we're going to talk a little bit about, you know, what does this mean and what is it that the markets are looking for. Now, I do think that we have this tendency to overcomplicate the markets. The reality is there are just so many moving parts, but I try to strip this down to what really is driving the price of the markets.
I mean, if we want to get down to the nuts and bolts, you could say that there have been a lot of people selling and
Yeah.
maybe not a ton of people buying.
Yeah, I mean, when you get down to supply and demand, that's ultimately it. So what happens is just not a lot of appetite for purchase right now. So there's low demand, and there's a lot of people that want out because of fear primarily, and so that is a high supply.
Right.
Okay, so with high supply, low demand, prices fall.
I guess the silver lining is the closer, to the bottom of this, wherever that is that we go, there's going to be more and more buyers.
Well, right, and so there are lots of different ways to frame this. Let's talk about a few of them here. But before we do that, I mean, let's ask ourselves, why are the markets down? And if you find yourself going through a litany of reasons, like, well, because of inflation, because of Putin, or because of Ukraine, or because of this, or because of that, then I will say, okay, all of those are reasonable thoughts to it, but you're overcomplicating it. You're actually trying to give me the reason that everybody has in common. And the answer is, I don't know why for sure, but I can say a confluence of events have created this cocktail that lead us to have an imbalance of sellers to buyers. So people, it's the perception of the buyer This is a lousy time to own stocks. And so the market declines. Interestingly enough, it's not just the perception that matters, but it's the aggressiveness of the buyer or seller. And it is the depth of the market that also contributes to this.
Right.
You know what I'm talking about,
Yeah,
everybody?
because it's like if the aggressiveness of the buyer says, I don't want to be in the market at all, and that carries through the markets and people do a full liquidation, that's a much different event than if someone says, you know what, I'm not too scared by this market, I'm going to maybe pull 10% out and let the rest of it ride.
Right. And I've seen over the course of my career a lot of people riding the emotional roller coaster start to make binary decisions, right? Like all or nothing.
Sure.
I think that's a terribly dangerous thing to do.
Mm-hmm.
There are a couple of things that I think we should point out, just data-wise.
Okay.
So first of all, how often have you heard, for example, the market's just lost X trillion dollars of market cap?
Yes.
Have you ever heard that before?
The news catching headline articles. That's what I'm going to
Right?
about that.
Like if the S&P 500, if we added up all of the stocks in the S&P 500, like the total value of all the companies,
Mm-hmm.
and I'm just going to say, these are not real numbers, but let's just illustrate. So let's say it's worth $100 trillion.
That was
of
the
value.
same number I had in mind. That's funny.
Okay. So $100 trillion for all of the companies in the stock market.
Okay.
We're going to say S&P 500. So if they added up to this, I don't know what the real number is, but that's what we're using. And then when we go through a bear market with a 20% correction,
Mm-hmm.
right? Or not even correction, 20% decline. So it goes from 100 trillion to 80 trillion. So people say, we just wiped out 20 trillion of value.
Mm-hmm.
And my question to you, and so I'm going to play Socrates with you, Matt, and
Sure.
ask you questions, is that accurate?
I mean, I think the way I would look at it is going back to, say, a year ago, and I would say, well, if we've lost 20% from January, where were we a year ago?
Well, so now, what are you trying to measure? This
I'm
is
trying-
fun. I'm just gonna
so
ask you
I would be
questions. I'm going to
trying to-
interview you.
Yeah.
Yeah.
I mean,
What
I
do you
would be
think
trying
you're
to-
measuring that way?
I would be measuring a percentage change from maybe the last 3 years, and then comparing that to a year ago. Not
Okay.
necessarily trying to measure by the dollar value.
Okay. So you're talking about percentages,
Mm-hmm.
but so you're delinking from market cap entirely.
Yeah,
Okay.
I would try and delink because I just don't know that that's a fair way to analyze things.
So why do you think that's an unfair way? There's just so all of you listening, there's not like there's a right or wrong answer to this one. I'm not necessarily even seeking an answer from Matt
Right.
that to get here. So this is not, and he's on his toes on this one. I didn't prep him for this either. But
That's relative, I think. I think where I'm going with this is to say that the amount of money that we're evaluating at is relative because at any moment in time, right, it's fluctuating, that total amount. So I don't necessarily think that to measure it by a dollar amount would be accurate.
well, if everybody wanted, so here's the thing. Market cap to me it's an interesting measure, but is it relevant?
I don't know that it is.
I mean, it is if you're like a small business and you're trying to sell your business and you want to know what's the value of my company. But I think it's sort of silly. I mean, it's a novelty to measure the market cap of everything, to measure the market cap of the S&P 500. But is that possible to get? Like if you were an investor, could you somehow own the whole market cap of the S&P 500?
No.
Right, and not only that, if let's pick a company, we have an ABC company that's worth $1 trillion.
Mm-hmm.
If that company were to fully liquidate, meaning they were to sell everything, it's not going to be worth $1 trillion, right? Because in order, you'd have to have demand go to zero. Nobody wants to buy it anymore. So who's going to buy it if everybody's selling it?
Right.
Like who's going to make the market if it's a complete liquidation? At that point, it's a bankruptcy. And then it's more like, well, whatever parts are left that people are willing to sort of scoop up, that's the value now. And by the way, there are people that look at the market and try to value it that way. There are value investors look at the book value of a company. It's like, well, if we just added up all the parts to everything, what's all the stuff worth? Just the assets and the real estate and the vehicles and the tools and equipment and all the stuff. What's that worth? And they said, well, there's your book value per share. And then you compare it to the actual value per share and you start to go, okay, well, what are we paying for future earnings? Right? Lots of different ways to analyze a company, but in the end, what are they all doing?
They're trying to find price discrepancy between that trading price and what they actually think that it's worth.
Yeah. And I would say
those aren't always the same thing.
Yeah, and in simple terms, like we're just trying to rationalize whether or not I want to own it.
Yeah, is it a good buy?
Yeah. I mean, when Zoom, the video teleconferencing company, at the beginning of COVID shows up, I mean, look at the stock price shoot up to, I mean, basically it said, well, you're going to get paid for the next 30 years of income this year.
Mm-hmm. Because wasn't it like $3.50 a share?
It was something comical.
Yeah.
You looked at it and you're like, well, this company doesn't earn anything yet, relatively speaking, but we're willing to bid the stock up because everybody's going to adopt Zoom, they're going to make a fortune. And then when the world started to reopen again, stock starts to collapse because the use case has changed.
Yeah, that kind of blew my mind, right? Like Google exists, Google Meet exists, yet we're going to value Zoom on the level that.
Well, but lots of Skype was there, and
yeah.
FaceTime was there, and Microsoft Teams was there, and like there's tons of different platforms, but Zoom somehow became the flavor.
Mm-hmm.
Or how about DocuSign? We're all going to do digital signature. By the way, DocuSign's down like 75-80% from peak right now. I think it fell like 20-something% just either in the last few days. So there's another example of, well, everybody thought for a while it's worth it. It was a feeding frenzy of buyers, right? All the lemmings.
Yeah, we're going back a couple weeks to our prior conversations of SpecTech.
SpecTech. Yep.
Yeah.
Those and so why does this matter? Because we got to talk about inflation. We got to, that's the whole point of the show. Is how's the market going to digest inflation and why does it care? So what inflation is going to do is it's going to influence buyers and sellers. It's going to change their opinions of the market.
Mm-hmm.
Okay. The question is how and what does that mean for us as investors? And what I'm telling you is there's really not a right or wrong answer. There's going to be a bunch of theoretical answers, and then we have to parse out which one makes the most sense for us as investors, or what do we think is the major theme that the market's going to pick up on, and can we try to get in the center of that trend?
Are we going to theorize on that later?
We're totally going to theorize on that.
Oh man, that's
right?
Fun.
But they're going to make us take an equal profit break first, so I think we got to do that. So, all right, there's music. That's what it means. So stick around, and when we come back, we're going to talk more. What does inflation mean for you? Right, that and more. But first, these very important profit messages. So this is Dave Littlejohn.
And Matt Dixon.
And you got True Wealth on News Radio 93.9 FM, 1240 KQEN. Look what I found.
Where did you find it?
Sitting on the desk right here.
So does that mean that we get a freebie?
No, I think that was the one you were looking for. I think we had one that was sitting out the whole time, and we were like,
oh.
So I don't think it's a freebie. I think there was a 3-pack. And that's
Oh,
the
it was a
one.
3-pack. Yeah, that's right.
So we've had it all along, just like the puff rub mic. And hey, gang, welcome to YouTube or whoever's tuning in right now. Feel free to drop comments in there if you got questions. Matt and I are kind of unpacking inflation. We're going to talk a little bit about how it gets measured. We're going to talk a little bit about what it means for investors and so forth. You can tell we're at our commercial break right now. I don't even know what.
Do we have any comments?
No, we do not.
Encourage them to comment.
Okay, you're
What they
encouraged
have
to
to
comment.
say.
It's actually shrinking back down to, like, I think we're the only viewers on right now. We're that interesting. So it's interesting, all these different ways that inflation gets measured. There's 4 primaries, right? CPI, Consumer Price Index.
Okay.
CPI less food
You
and
have to
energy.
define CPI in one sentence. How would you describe it?
Consumer
How they actually
Price
mean it.
Index.
Yeah.
Well, it's an average of 80,000 or so different data points for prices of items that people routinely buy.
Okay, we should probably talk about that.
Yeah, and then the Bureau of Labor Statistics brings that up, and they survey people across the country say about 400 people that they collect data from, and then they develop averages around that. Then you've got CPI less food and energy, assuming that core CPI, if you take food and energy out, that's the volatile stuff. So it's kind of a, yeah. Hey, thanks, Paul. Facebook, I just saw a cool comment there. But anyway, so the PCE, so personal consumption expenditure, which is actually calculated by a different group, and then core PCE. I have sneezed.
And then there's Matt's way of measuring inflation.
I gotta stop sneezing. Well, hey gang, welcome back to True Wealth Radio Show, where
David's barely alive. He almost sneezed himself out of this world.
Right in the middle of go. I don't really have allergies or anything, but apparently I did get to sneeze during the break.
You're allergic to inflation, David.
I am. I'm trying to talk about it. I just can't handle it.
Sneeze.
So, welcome everybody, and thanks for tuning in. Those of you on the live stream, we do see the comments coming through, so it's good to see everybody, and thank you for those that have offered blessings after my sneeze. It's currently live on both Facebook and YouTube.
So just go to Little John Financial on YouTube.
Yeah,
click on the live
it's
video.
it's streaming on my personal Facebook page, our business page, and then on YouTube as well. So what I want to talk about now, here's the next segment. Let's get into the goods here. There are a lot of different ways that inflation gets measured, and the reason we wanted to talk about this is when our investment committee got together this morning, one of the things we talked about is what's the major themes going on in the market? And inflation was kind of the takeaway. The first one was, darn, gas prices are high, right? And they are. In fact, here's my question to all of you listening. Has your behavior changed because of gas prices? Right? Do you drive differently now or drive fewer places?
I did finally put my truck in eco mode the other day.
Oh my goodness, it's a huge impact right there.
I saved a full mile per gallon, okay?
Gone to eco mode, changed the shift points in your truck, which just goes to prove shift happens. So
it's going to be a radio promo.
Indeed. So how do we measure inflation? Okay. Well, interestingly enough, the government likes to track lots of different ways, and there are probably tons of ways. But we want to talk about inflation because it's very, very relative. And we're going to talk about this, and we're going to talk a little bit about the yield curve. Okay. Inflation yield curve. I think investors, if you get a better handle on some of these moving parts, it'll give you a sense of the themes that are really driving what's going on here. Like it to a certain extent, it explains why the markets are behaving like they are. But hopefully it will also give you a little bit of a grounding in like, well, what does this mean and what ought I do? Okay. And then you have to frame that as careful because we don't offer investment advice on specific investments, but strategically, I think there's some things that you need to consider. So first, Matt, how do we measure inflation? Like, where did the 8.6 figure come from?
Well, I know one well, I guess, and that's CPI.
Right, which stands for?
Consumer Price Index.
Okay. So first of all, do you know what governing body measures CPI?
You know, I actually don't, so surprise me.
The Bureau of Labor Statistics.
Okay.
Okay. And this is not super important. It's just interesting to know because there's more than one government agency that tracks inflation.
What's the other?
So the other one is the Bureau of Economic Analysis is one of them. And then also, and this is interesting, there's the Federal Reserve system has different measures, right? So like there's the St. Louis Fed or the Chicago Fed or there's the Atlanta Fed, and so the New York Fed. There's these different Federal Reserves, and they all have their different research bodies.
Is there much of a discrepancy in their numbers? That's
so
curious
not necessarily, right?
So they're all kind of on the same page, relatively.
Not necessarily. It depends. They measure different parts for different reasons, right? So as an example.
So there's not a ton of redundancy where they're measuring the same thing. They're looking in different ways.
There's just not agreement, right? So as an example, personal consumption expenditures is different than CPI, Consumer Price Index, right? That's PCE versus CPI. And so PCE gets measured by the Bureau of Economic Analysis, where CPI gets measured by the Bureau of Labor Statistics. Right? So there's going to be these different versions of what is being measured.
Sure.
And then within those, there's different things too. So I know as an example, this is not for inflation, but for gross domestic product, which is measured by the other group. I keep toggling back and forth because I don't even have them memorized, right? The Bureau,
so many of these things.
this one's measured by the Bureau of Economic Analysis, right? So they do GDP. Well, the Atlanta Fed has a version that they call their GDP Now, which is a faster moving statistic, and they use some different underlying elements to track
So
what's
do they
going on in the economy.
remove a few layers? Like, do they take energy out and just look at, like, that'd be interesting to do like a full breakdown and look into the depth.
Oh,
of, like,
there's
how they measure
there's
it.
so many ways. Like, for example, you could look at the CPI, right, Consumer Price Index, or you could do core CPI, which removes food and energy, or then you could just look at food and energy, right? So the non-core parts of
Right.
CPI. There was a term, I don't remember where it came from. A friend of mine showed it to me called sticky CPI versus something else. And basically, the sticky CPI is lower. That's the stuff that once it changes price, it tends to stay there. So like wages, right? Wages historically don't contract much. You'd have to go through a pretty significant contraction period in the economy. So you go through a recession, okay? And if you don't know, raise your hands again, unless you're driving, if you know what a recession is, because we're going to quiz Matt and see if he knows what the definition of a recession is.
Okay.
Matt,
Are
what's
we
a
doing
recession?
it right now?
Yes.
Okay.
Right.
I
And
think-
no Google time. We're just going to catch him on his toes.
I think it was 3 or 4 consecutive quarters of economic death. 2?
No, it's two.
2?
It's 2.
Okay.
Yeah, 1 is a warning, but 2 consecutive quarters, we call it a recession.
Was
And then
it 6 that you
beyond-
have to be a?
I think beyond 6, and we start to call it a depression.
And now, have we gone past 6 since the 30s?
Not that I recall.
Yeah,
Even
I
in
don't
2008,
think so.
we didn't have that long,
Right.
right? And that was the worst one that we talked about, the Great Recession, right? Which was this severe recession, but technically didn't
It
last
didn't last long
more
enough.
than 6 quarters.
So for all of the people that are like, this is going to be 5 or 6 years of pain, it's like, well,
yes,
historically,
right.
over
And
the
then-
last 100 years.
yeah, so like bear markets,
Not
as an
even.
example. Now that we're in bear market,
Mhm.
side note from our inflation conversation is shortest bear market, I think, is about 30 days, which
Mhm.
happened in 2020.
And we've actually seen this for a while now. We're in month 6. So,
Well, we've been
now
declining
right.
for 6 months, or almost 6 months.
right.
And the average was something like 13 months. The longest was like 5 years to get out of a bear market. And remember, one of those was the Great Depression.
Right. So excluding that.
If you exclude the Great Depression, the statistics get better, right?
Right.
So
It's kind of an outlier.
So it's really one of those deals where if you can adjust your time horizon and patience level, it would radically benefit you. Okay.
Yeah.
My sense is that despite the chaos that is our system right now, things are largely going from lower left to upper right in all categories, right? We live in the United States, we have such peak levels of human comfort, right? And that's not to say that there's not tragedy in the world, there's not crime, and there's not terrible circumstances for individuals. But in aggregate, people are so comfortable and they have access to the internet and other resources. I'm not saying there's issues with food security, yeah, those are real issues. But in general, things are better now than at any point in history.
Right.
As far as your personal comfort and your access to entertainment and all the other things that come with it. It's like we have air conditioner, right? We have food that's readily available. Even in periods when it's hardship, right? There's still food available. It's not starvation. It's like changing what's available. And I'm talking about for the United States largely. You know, we are at the point of inventing problems to complain about because we have so few hardships, right? We've developed much more exotic social issues than would have ever occurred to people 100 years ago who just wanted to not starve.
And I actually appreciate the word there, developed, because we really have manufactured issues.
We do,
Yeah.
right? And for the people that are really, really passionate about it, this may be very, very insulting. And I kind of go, it's perspective here.
Mm-hmm.
It's all a matter of perspective that we really have it made in most perspectives. And so we can then folks get into, well, it's the game of more. And if you've never heard me say this on the True Wealth Show, I'm going to say it now and take this in. The game of enough is the game to play. The game of more, you'll never win. Okay? You want to be unhappy in life, play the game of more. You will always be unsatisfied. It's difficult to be grateful for anything. Everything becomes a contest. And if your wallet is measuring your self-worth, you're doing it wrong.
Mm-hmm.
Okay? We get it. If you're broke, it's hard to be happy. But the game of enough is a way more sensible game than the game of more.
Sure.
So just keep that in mind. Now, back to home base. Okay. This whole inflation discussion. Okay. We're talking about different ways that we measure it, like CPI is a way. CPI less food and energy is a way. Personal consumption expenditures, right? What are the things that people have to buy, right? So that's a different one. Personal consumption, excluding food and energy. We keep wanting to exclude food and energy. And of course, what are the most expensive things right now?
Food and energy.
Food and energy.
Let's not exclude those.
Yeah. And then there's all these other ways. So let's just, at this point, I don't think there's any this argument over whether or not we have inflation.
Yeah.
I will also tell you some measures of inflation I've seen are approaching close to 20%.
Mm-hmm.
Okay, so how we measure inflation, like which goods and services were tracked a while ago, looks different. So we also have a question, by the way, how did producer price indexes figure in? So we'll address that in a sec. But if you look at every time I do that, if I look at a question in the middle of
It
the
just
show,
derails
it
you.
derails me because I'm like, really? You want to talk about that too? But the home base idea that we have lots of inflation, some of it very, very high. The reason I think we don't use super high measures, I don't think it's political, believe it or not. There's some people out there, oh, so and so wants to say, no, spare me on that one. I think it's because it's inflammatory. You start to get kind of kooky behaviors when you take some of the smoothing indicators out.
Mm-hmm.
Smoothing indicators, it's like a filter, right? If unfiltered data, then you get the real extremes of the statistical extremes that start to make things look maybe abnormal. And so when you see a 17 to 20% inflation
You
print,
almost make the problem worse.
you can just scare people for one. And so I don't think that we have nearly that high in inflation in aggregate, but there are areas in the economy that we do. And an example would be things like the radical escalation in oil prices. Fertilizer spiked up. A lot of commodities spiked up. But then we also see the same commodities. They're just way more volatile. So wood prices, lower now than they were 5-6 months ago.
Mm-hmm.
Okay, and they're historically cyclical. They're agriculturally related. They're also market dynamics at play. And so you see demand destruction when things get too expensive, right?
Mm-hmm.
It's the old thing about like beef prices skyrocket, and then people buy less beef, right? And then it's like
chicken. And
yeah,
the price of chicken goes
and
up.
so
because there's
but I don't think you can invest in Chick-fil-A. I think it's privately held. So there you go. But that is and it's fun. We've got my buddy online, Evan B. Farmer, who's he's the one who's commenting. Says things like fertilizer are ridiculous. That is true, right? There's been a major supply disruption because of the war in Russia, and then and then there's also been a certain amount of like a run on things. Everybody panics, and so it's like, oh, toilet paper and now fertilizer. So that's going to drive an imbalance.
Yeah, and I saw that Europe's second largest producer shut down. And so when you mess up the supply chains, that also drives prices.
Yeah. So we will let's unpack some more of this. As I'm looking at the clock, we're running a tad long here. So yeah, what we'll do is let's grab a quick break, and when we come back on the flip side, we can talk more about producer price index, and let's talk a little bit about wholesale price as well. But first, this break. This is Dave Littlejohn
and Matt Dixon.
Yeah, True Well on News Radio 1240 KQEN. I forgot the old call sign. I forgot 93.9 FM.
Did you happen to see that comment I had in the investment committee meeting on Monday about the fertilizer?
Yes.
That stock ended up jumping 8% today as the market got slammed it off.
Yeah. So I still think that I have to be careful when we say these live streams. You said that stock, it's kind of like that airplane stock in Seattle that I think's interesting now.
Yeah.
And I'm not saying it's investable yet, but I want to do more research.
Yeah.
It's like, how do you say that on air without getting caught? The price of diesel exhaust fluid is going to get absurd. Diesel exhaust fluid?
Def. Yep.
You have to bring me into that one.
All the new diesels, in order for them to meet emissions, you have to put fluid in it. It's like an afterburner, so it takes the exhaust and then the DEF burns it off, and then you get a clean emission.
Okay.
And the vehicles will shut down and not run unless you put DEF.
Right. And I suppose so too. Yeah. Thank you, DEF. And any labels, yeah. So since I've got the farmer family commenting here, is there anything specific around the producer price index that you were interested in unpacking on air? So I could ask that off air as I look to how to program in on this stuff.
Steel and aluminum,
right? Yeah, the price index is of course a different component, and what does it cost to produce it? What are they getting people selling it for? Right. That's a different one too, because then we can talk about where does margin for businesses. And you've really brought that up. Why is it higher than consumer inflation? Oh, for sure. That one. We talked about that.
Evan?
Yeah.
Ask him if the sound is bad. Heather says our sound is bad.
Oh, is our sound bad? Can you guys?
She says there's an echo.
It's probably a little echo because of the headphones here. And we've got the speakers going, right? The monitors are on. When we turn the monitors off, they should go away. Why is it higher than consumer inflation? Well, I guess I should know what the current measurement is too before I say that. 10.8. So yeah, in May. And the answer is mostly margin issues, right? It's costing more because of wages and so forth. So initially the producers are eating it, trying to preserve market share, but at some point it's going to start getting passed on, and then it shows up in the CPI. So, but now we have to say it on the radio too, not just during the break, right? Thank you, Andrea. Some of what was causing it, I believe, is these headphones were too close to the microphone and you were getting a feedback loop. Here we go. All right, gang, welcome back to the True Wealth Radio Show, where if you were just joining us, we are live streaming, so you can grab us on Facebook if you'd like to check us there, or YouTube, both live streaming. And if you were going to miss it, it will also be available as a podcast.
Yes.
Right? Available at shameless plug, Matt?
How about littlejohnfs.com?
Very good. Perfectly shameless.
Educate tab.
Nailed it.
Educate go. So.
Yeah. So my good buddy, Evan B. Farmer, asked in the comments during the break, and we're going to bring this up, a discussion about PPI versus CPI. Okay? Now, since the theme of today's show is what do investors need to know about inflation, so first of all, we talk about CPI, Consumer Price Index. What is PPI?
Performance Price Index.
Producer Price Index.
Darn.
Right? It's okay. There's not industry tests to learn this stuff to get into the advisory world, because you actually don't need that for financial planning. So it's just like that armchair economics degree that you earn over the years of doing this, right? So the Producer Price Index is a survey that tracks what it costs, like it sounds like, to produce things. Okay? And so what we saw was a CPI print over the last 12 months of 8.6%. Now do keep in mind, that's not 8.6% higher than last month. Last time we measured it was 8.3, now it's 8.6. What that is a 12-month look back, say from from 12 months ago, we're this much higher than 12 months ago.
Okay.
So we're seeing the trend is higher, but the interesting, but it's not like a month-over-month compounding effect. Can you imagine if we were increasing at 8% per month?
Well, then our money wouldn't be.
By the end of the year, that we would be hyperinflation, right? We would legitimately be at a point where it's like, well, gosh, in a year, it's
$100 for a loaf of bread.
yeah, you're like, well, that's just not going to work. Okay, the PPI, why that's important is it's actually been measured higher. The May print for PPI, if my data source is correct, was 10.8%. And the question would be, why is the PPI higher than the CPI?
Maybe because companies haven't started to fully price in the cost of production yet.
Right.
They're just making less money.
It's basically coming out of the margin of producers.
Sure.
Right.
They're the ones that are kind of absorbing part of the blow.
Yeah.
So it's getting passed along to the consumer, but it's also dinging the people that are manufacturing.
Right. It's affecting margins. Now this is important to the stock market. Okay.
Because earnings will shrink.
In theory, yes. If it's coming out of profit margins, unless your profits in general are increasing, right? Because it's not just the profit margin that matters to analysts, but the total profits, right? Hey, you're a multi-billion-dollar company, and your profits were 100 million a year, and that's a 10% margin. Next year, your profits are 150 million per year, but it's a 9% margin. Okay, well, you made more money. But as a percentage of the total, you had less total efficiency, but you made more money, right? So it cost more, but you made more. Okay, so your margins may be shrinking, but your total profits are improving. Okay, well, the issue with PPI is it's suggesting that the cost is going up, but if it's going up faster than CPI, it also suggests that the producers are potentially taking the haircut. So they're taking one for the team before the consumer feels it.
Right, and that can only go on so long before prices have to raise, and then we see more inflation.
Well, that, or it would suggest that more inflation will likely appear on the tape, as we say, right? It would show up in the future numbers that there's still more inflation to watch out for. So that would be one of the economic theories that you propose, or the economic outcome of this is, well, if you've got these numbers that are disconnected, either with inflation coming down with higher rates, then the PPI should start to decline, or CPI can continue to be pushed higher. This also, incidentally, is why the Federal Reserve is painted into such a corner.
Sure.
Right? Because and what that means is, like, do they have an option about raising rates or not? And one might argue, well, sure, you can just make the wrong decision and not raise rates, but the market is now expecting 0.75% rate hike tomorrow. Wednesday, right? So today's Tuesday. So they're meeting today and tomorrow. They're expecting the date it to be released tomorrow afternoon. So when tomorrow afternoon Eastern time, right? So when that occurs, then we would say the market's now handicapping as if we were expecting 50 basis points, right? Remember, 100 basis points equals 1%.
Yeah.
So 50 basis points is 0.5%. And now the markets are handicapping, are starting to price in the expectation of 75 basis points because these data points are not coming down, right? Federal Reserve started raising interest rates. They expected to see CPI begin to decline. It continued to go higher. So the markets have kind of panicked. You're now, and can you see how the data fits together now? Like, wait a second. If PPI is higher than CPI, and CPI is still going higher, that means potential profit crisis for more companies in the market. We better discount future values and the price goes down. Okay. Now, all of this to say it's still just a game of who's going to rationalize what price they're willing to pay.
And how much of it's already priced in. How much is the market reading into this?
Exactly. Did they already bake that into the cake, and now they're saying, like, well, if the Fed comes out with only 50 basis points and we thought it was going to be 75 basis points, woohoo, that means it's good.
Not that you can predict this, but how much of it do you think is already priced in? If you just had to guess. What's your gut tell you?
Oh, so this is the old theory of efficiency, right? The efficient market hypothesis would posit that 100% is priced in. But what we're pricing in, I think the real question is not what's priced in, but what unknowns may yet occur,
Mhm.
and how might you price in the probabilities of those
Right.
unknowns?
Right.
And because I don't know them, I
You
can't
can't
really
answer
answer the
it.
question. So
Yeah.
all I can do is take an educated guess.
That's
Right?
kind of where I'm leaning
And-
with this.
well,
It's
and my
like, we
educated-
just don't know how much of it's priced in.
Yeah, but I'm willing to do dumb things like I take educated guesses on the air because
Oh, okay.
I'm crazy, right? You're not supposed to name a price or a time at the same time, but it's that time of the day and we're rummy. So I would say that the Federal Reserve, I believe, is behind the power curve policy. I think they probably will be forced to raise it 75 basis points.
Mhm.
They will continue to say that they are data dependent. But I think that this thing is quite challenging right now. I think that the confluence of events has been underestimated.
Mhm.
And some of this is, my own projecting, right? When I say underestimated, things like the labor force participation rate being a significant problem, but they're saying it's not a significant problem. I know too many people trying to hire that can't, so they can't run their
Do you
businesses
think
because
they're
they can't.
undershooting that?
I think that they're underselling some of the structural problems of the economy,
Mhm.
and it's the idea that data wonks are sometimes out of touch with the reality of the marketplace. And just like the gap between CPI and PPI, I think that what they're inferring from the data is not inferring aggressive enough for what's really happening in the marketplace.
Okay.
And so by the time they get caught up, I think it's going to be like, oh, now they may even overshoot it, right? Like, oh, now we got to lower rates because we were successful at killing this thing and we shot too far, and now we got to try to spool it back up. And why does this also make sense? Go look at the yield curve. If you wonder what the heck I'm talking about, now you have to stick around for the last segment where I explain to you what is he talking about, what does he mean by the yield curve. But that's the message to come right after this. So stick around. We'll be right back. This is Dave Littlejohn.
And Matt Dixon.
And you got True Wealth on News Radio 93.9 FM and 1240 KQEN. How's that? Okay, now I'm reading comments. So industry is taking one for the team. Yeah, we kind of talk about that. And then we said, each device has an ambient microphone active. When one device lags a little, it gets echoey. We are wearing mics. Headsets might help, but we're wearing lapel mics. Each of us are, so who knows?
Yeah.
And then also, sometimes I probably get too loud. Your mic probably picks me up when I get animated. We'll work on it. Maybe headphones are a solution.
Yeah.
We're still experimenting with this, so the live stream is kind of a new thing, but I love everybody's feedback. I love seeing you guys online and in the comments, and we'd love to. By the way, everybody on these feeds that are watching this and in the comments, you're going to help us prepare future content, right? Because this is really to be educational in nature, and it is to be beneficial to the folks that are consuming it. So if you got questions or comments, throw them in there. We're going to read them all, at least until we can grow it so much that we can. That'd be a cool problem to have, though. And then we're going to use that to build out. Right? So we'll cover more stuff from there.
And maybe one day have her own studio.
Right? Welcome, Gunner. Good to see you. We are at commercial break right now, and so we'll be coming back in a moment. You probably won't hear the music in the background, but it's there on the monitors, and then we'll talk home stretch. We're going to talk about yield curve, and yield curve's kind of tipped its hat to something that's interesting in the economy that says, the Fed's got its hands full now. Yeah, you want to try to cover this one?
How gutsy the Fed is?
Well, no. Like, what is the yield curve implying, and why is it tying the Federal Reserve's hands?
Oh, because short-term borrowing is more expensive, or
well, that's what an inverted yield curve means. But
yeah.
what might ripple through the economy as a result of an inverted yield curve? Right now, this one is the game of you pretend you're a dollar bill flying through the economy, moving from the hands of everybody. Right?
Can you please do it just like that during this next segment? Just
Yes.
like really tone it back for us and just walk me through it. I want to see these visions, okay?
Yeah. All right.
It's
Well,
gonna give us
welcome
visions.
back to the home stretch of the True Wealth Show.
It's about to get wonky.
And I'm not even sure if it is, but thanks for tuning in, everybody. And if you're just joining us, you can grab a podcast. We've also got a live stream going on at Little John's like Little John Facebook page, my personal Facebook page. It's also on the YouTube, so we're all there. And I promised at the break we'd talk yield curve, okay? Because the yield curve is telling us some interesting things. We talked about inflation,
Right.
We talked about the gap between CPI and PPI, right? Remember, a consumer price index which says, hey, inflation's at 8.6%, and then the producer price index is at 10.8, which suggests that producers are eating it on this one right now, right? They're actually getting hurt more than the consumer. So their prices are going up even faster. Either that, or because of their prices going up so much, they're passing a lot more on, and it's fueling the inflation feedback loop, right?
Yeah.
Their products cost more, so it costs more for the consumer, which drives up inflation, which drives up their costs more. So we got this inflationary spiral. So the Federal Reserve is like, we got to do something about inflation. What are we going to do, right? And they start raising interest rates. And remember what's really happening. Under the hood, when interest rates rise, you know what we're being told as investors?
That to borrow money, you're going to have to give a better rate.
Well, yeah, the person borrowing is going to have to pay more, right? So if you're out there buying bonds, remember you're making a loan when you buy a bond.
Yeah.
I know it's backwards of what, but if I buy a bond, I'm making a loan. I'm buying a loan, right? If I buy a government bond, I'm loaning my money to the government. They're going to pay me interest, and then at the end of the time period, they're going to give me back my money in a balloon payment.
Right.
So that's what a bond is. Well,
so long-term rates should be higher than short-term rates.
Historically, long-term, it should be the longer you tie up your money, the greater at risk it should be.
But lately,
that's not the case. We have an inverted yield curve. This is a big dog whistle in the economic world because historically speaking, when that occurs, it signals a recession, and it's been a very effective signal that a recession is on the horizon. Okay, but where's the Fed stuck on this one, right? And if you think about borrowers, right? If you're going to make a loan, I don't want to make a loan and get paid back with less than I lent out. But in an inflationary environment, you're effectively saying, oh, sure, I'll lock my money up for 10 years, get paid 3%, and inflation's running at 8%.
And just no one's going to do it.
Yeah, why would you do that? That's like a knuckle.
Someone's going to do it, but
well, the only reason people do it is because they need to hedge other things.
Sure.
So they need a security blanket, if you will, so they can do this to hedge something else.
They need someplace just to place the money.
Right. So you'll see that when you need to offset a corresponding item, so they're balancing each other out, so that you can be neutral. But largely, you're not going to see people do that, right? So you're going to see bond prices fall until interest rates match the higher rates of the marketplace, and so it's going to cost more to borrow money. And so that's why mortgage rates go up, for example. If rates go up, who's going to give you a low mortgage rate when they have to make up for inflation? This is pricing risk. It's part of the story here. Okay, so if rates are going up and short-term rates are high, long-term rates are low, Fed's really got themselves a conundrum here, because when they raise rates, it's what they're effectively saying is the economy's telling us it's going to slow down. They need to slow the economy down, but if they overdo it, right, then the economy slows down too fast, and they have to actually try to flatten the yield curve back out. So now they got to lower rates again, and the problem is it's like moving a giant ship in the water, right? Try to turn an aircraft carrier around quickly.
Okay. I was imagining someone just like burning the pancake, like, oh, they turned the stove up because it wasn't cooking, and then you end up burning it. Turn it back down.
That's a pretty good one too. Burning the pancake.
Yeah.
The Fed is really stuck, aren't they? Because
you don't know where to set the stove.
And that is actually a great analogy, because setting it at the right temperature to balance things, the reality is it's unlikely to happen.
Right.
You're going to constantly be varying the temperature of this economy in the form of interest rates. And for a while, the Fed did pretty well. I just think that when COVID hit, it was like
it threw them a curveball they just couldn't hit.
Well, the Fed could only do so much, right? They can manage rates to keep them low, but it's really difficult when you get the kind of stimulus that the government, the type of direct money printing and injection of capital to the economy, as if that wasn't going to have an effect. I got news for you people. Like, we all saw it coming. The most JV, not even JV, like we're talking freshman squad economists, armchair economist. Okay, like I just read it on a headline in a Google news feed kind of economist could tell you you're going to print how much money,
Right.
and that's not going to have any issues in the economy. Like, no, nobody said it. People rationalize it. Sure, like, well, I'm like, well, I want the money. I want the stimulus because the government shut it down, and so I need it. But printing money doesn't actually make value occur.
So going back to the Fed for a moment. So hindsight's a little 2020. The
Yeah.
Fed's been catching a little bit of heat because people are saying, "Hey, you didn't come out swinging hard enough. You were a little bit behind the eight ball. You should have been more aggressive with these rate hikes." Do you think that they should have been a little bit more aggressive out of the gate? Because
Yes,
yeah,
that's my answer. And it's easy to armchair quarterback this
Sure it
after the
is.
fact. That's not a hard one. I think where they were ridiculous, and I do mean ridiculous. I've kind of said this for a while in advisor
just
circles.
slow to pull the trigger.
It's not that. Like, they kept saying inflation was transitory.
Oh,
And I was like, you have invented a term. Right? Like you conjured something to try to rationalize your
so
behavior.
you weren't buying that at all.
I wasn't. I've been saying this for probably the better part of almost 2 years. And this is stuff that I could actually document some of it by going back into like my blog posts.
And the podcast.
And so you go back and look at this, and what you would see is I've been saying that the dual mandate has been crippling the Fed for a while.
Expand upon that, the dual mandate.
Dual mandate is low interest rates and low unemployment. Measuring the unemployment. Like, they sacrificed for employment when COVID hit. It was like nobody had jobs, and so they had to find a way to conjure jobs. So they kept inflation low to allow the job market to catch up. But by the time the job market had caught up, inflation had already, the horse was out of the barn, and they had a problem. So, they're out there running around in the field with no fence, trying to catch this horse. Meanwhile, the job market has gone nuclear, and we have wage inflation. And so that's just where we're at. And like, guys, I think there was a combination of like hoping they were right. Like, we think it's transitory. And then, the supply chains just kept getting worse and
Do you really
worse.
think they thought it was transitory?
I think they did.
You think they really were?
So not everybody did. There wasn't agreement in the Fed. Lots of people were more hawkish.
So who does the blame fall on? Because that's the American way. You got to blame someone. So
the active Fed governors that get votes, right? So they have members,
So
and
the
then they
board.
have people that give us. So the Fed gets to own this in the end because they were the ones that.
So it's not all on Jerome Powell's shoulders.
No, Jerome Powell's the guy that gets the blame for it.
Okay,
He's
so
the
we're going
representative.
to point the finger at him.
Yeah, I mean,
Sure.
he's the chair, and so he's driving the narrative and choosing what comes on the agenda and so forth, at least as far as I understand. So
All right, Jerome, you heard it right here. We're calling you out.
no, I mean, I'll also call out Janet Yellen as the Treasury Secretary, who was like,
yeah.
oh, it's transitory
She
and
kinda
whatnot.
just passed the buck,
And
too.
I just look at this and say, it's not the case, right? Like they just were wrong. She said she's wrong now. I just go, well, yeah, but at what cost? Right now that you're wrong, you're like, oh, oops. Like, it's doesn't work that way, right? Lives are impacted here. We're all going, go buy an airline ticket or fill up a tank of gas, or go to the grocery store and you're like, oops, gotcha. That's how we roll. So anyway, well, look, there's the music. We're out of time for the day. So the story is inflation is real. It's going to impact portfolios. A lot of it's already priced in the market. What comes next, we're not sure. Join us for the next program. We can talk about that too. How do they reach us, man?
541-375-0898.
All right. If you need help with your investments, give us a shout. Otherwise, we're out of time. This has been David Littlejohn.
And Matt Dixon.
And you've been listening to True Wealth on News Radio 93.9 FM at 1240 KQEN. All right, gang. No fake words today, Evan. We had so much to cover that we didn't go there. Less fun, right? That's the boo statement. But we'll try to get them back. We continue to work on the format of the show. First, it was like we just got to figure out how to get the live stream live. Then it became how do we get we'll start working on the format next. How do we deal with the flow of stuff? We're going to try to get the audio improved. But I love everybody's feedback. Thank you a ton. So it was, and we appreciate Evan B. Farmer's contributions to the topic today. So good times. We're going to run. So until next time, thanks, guys. And please hit up the comments and share with friends and do the like and subscribe and all that cool stuff. We'll catch you later. Thanks, guys.